Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. If you would never like to miss a FANG Friday video, then make sure to subscribe to our YouTube channel and like this video so I know that you want more. Hit the bell symbol for an email notification. Now, my viewers know how much I love to take questions and comments, so if you have any, then send me a tweet or a comment on the video below. Koresh had a question about gold stocks and whether they are good in a recession as opposed to physical gold itself. What I will have to say to Koresh is that the answer is maybe. And the reason is that in the past, you see, the insolvency of major governments has not been nearly as dire as it is today. And I think what is pushing gold today up is precisely the fact that the value of money is falling. And given how urgently Trump is trying to push the market so that he gets elected this November, I can see that there's going to be potentially a lot of damage done to the solvency of the U.S. government, and therefore, I think there might be a really good move in the gold stocks ahead, and they might hold in bear markets. Now, very often, of course, in bear markets, people see everything falling and hey, there's a stock that's not falling. Oh, thank heavens for that. I can sell it, and at least things won't look so bad in my portfolio. So whether they will stand up in a bear market, if we ever get another bear market, another question altogether, I don't know. But we will be watching the technical condition of the gold stocks. And of course, if you're a client of ours, then we will let you know and make sure that you don't go down with the ship. I think today, before we get into actually looking at the FANGs, what I'm going to do is show you how the market looks. And actually, what I've done here is I've got a view of three markets and therefore three different messages. The markets we're going to look at are the NASDAQ 100, the Standard & Poor's 500, and of course the TSX Composite Index. The first line here shows what the levels are. Now, actually, sorry, this is actually the levels as of January the 15th, so it's not totally up to date, but it's not very far away. And the second line here shows the MV ratio, which is, say, the market valuation, the price to book ratio of each of those indices. And you can see, looking at the NASDAQ, that the NASDAQ is nearly twice as expensive as the Standard & Poor's 500 compared to the lowly SP TSX Composite, which is very, very cheap at about even less than 1.5 times book value. Now, what we do next on the next line is to compute the fair market value of each of those indices. And of course, we do that by compiling the fair market value of each of the stocks that we follow, and then we take a cap-weighted average of those stocks, and this then gives the fair market value. Now, I have told you before that the Standard & Poor's 500 had what we had thought would be a sort of a natural and nominal peak at its fair market value. And the reason that we thought that is because for the past 35 years, that has been the peak for the S&P 500. Well, that peak has now been not exactly left in the dust, but nonetheless, the market has now risen, so it's more than 3% above that as of today. If we do the same thing for the NASDAQ 100, well, we find that the NASDAQ is now 28% overvalued. Listen, that is absolutely standard for the high technology stocks at the sort of towards the end of a bull market. They get way, way, way overvalued. And of course, when they correct, they really correct. Well, they're 28% overvalued. And I think there's going to be a big correction here. And of course, featured heavily among these companies are some of the FANG stocks. The TSX composite, look at that. It's got a 30% upside. Well, how on earth does the TSX manage to get a 30% upside where everybody is got massive downside? Well, the answer is really simple. The weight of the financial stocks in the TSX composite is about 30%, and they have absolutely huge upside potential, as, by the way, do the financial stocks in the S&P 500, but they're much, much less weighted in that index than in ours. So we show a huge upside potential based largely on the financial companies. Now, where do we go from here? Well, at this juncture, from a technical point of view, using SVA measures, the Standard & Poor's has good support at its mid-growth price. That's 2.5 times book value, which is $26.75. So the downside to that support is almost 18%. Compare that to the composite, the TSX composite. We have maybe a downside risk of about 12% before it gets to its high mid price. That's 1.25 times book value. Now, what is really interesting is where is the nearest ceiling? Well, let's take a look. The NASDAQ, the nearest ceiling is its bubble price, and you know that term because I've used it many, many times in looking at the FANG stocks. The bubble price is 7.4 times its book value. So if the NASDAQ were to get there, it would have to rise another 19%. Looking at the S&P 500, the nearest upside potential, or nearest upside target, would be its super growth price. That's 3.5 times book value, and that would give the S&P a potential upside move of a little more than 13%. And if you look at the difference between the 19% for the NASDAQ and the 13% for the S&P, of course, the difference is the relative volatilities of each of those companies. The NASDAQ is about 1.5 times more volatile than is the S&P. As for the TSX, well, to get to its nearest breakpoint, which is the high conservation price, which is about 1.5 times book value, it has about a 5% upside move ahead of it. Overall, given the fact that the Standard & Poor's has actually broken out over its fair market value, that's 3160, I think the FANG stocks have actually acted as if that fair market value was another breakpoint. And therefore, we might consider that the potential move for the Standard & Poor's 500 could be the super growth price, and that is where the S&P peaked in 2000. Okay, now the difference between then and now is that the fair market value and the super growth price were the same in 2000. Today, the fair market value is only 3160, whereas the super growth price is 3687. So we'll be quite interested to see the SG price, if the market gets there, is likely to be powerful resistance as it was in 2000. Okay, let's now turn to the FANG stocks and see what's going on there. And the first thing actually I wanted to show you was Alphabet, not to show you Alphabet, but to show you the importance of the SG price, the super growth price, which has been the kind of the midpoint for that stock for for 10 years. But what we're really interested in, of course, is the very short term. And here we see the Alphabet actually breaking out now over its super growth price. However, as you recall from the first graphic of Google I showed you, Google has actually not managed to get to its MSG price. That's 5.5 times book value. Hasn't managed to get there in 10 years. So I have my doubts that it's going to get there. But on the other hand, it has given us a buy signal. And I think that as long as the market persists on the upside, then it is likely that Alphabet is going to give us some more gain. Amazon, well, remember we talked about Amazon last week, and I said to you that Mike had emailed and said, well, he decided that he would buy some because, after all, the stock had been kind of just sitting there now for some while, and he thought it should go with the market, and he was quite right. The market has Amazon has gone with the market. However, it's not kind of showing what I would call like a lot of follow-through. In fact, recently, with the market being fairly strong, Amazon has kind of tailed off a little bit. So it may well get back to its HB3, which is 2,000, but it's not what I would call robust. Say, compare that with Facebook, which also broke out and checked back, and on the breakout over that fair market value, okay, here's the breakout over the fair market value on December the 19th. Facebook has been moving steadily higher, and I suspect as long as the market is able to go up, it'll probably pull Facebook higher. So we can say we've kind of got a buy on the stock. You'll see that in the past there has not been a lot of follow through there, but we've kind of got a buy signal on the stock. Netflix, well, despite its very, very questionable fundamentals, what with all of the companies going into the streaming business, Netflix continues to attempt to move higher and could well get to the HB4 if the S&P can reach up. If the S&P can reach up. If the S&P can reach up to its super growth price. So that's a big if, but nonetheless, that's what Netflix appears to be trying to tell us. NVIDIA, well, NVIDIA, unlike the other stocks that I've showed you, has yet to break out. Now, it's banging up against that HB2 ceiling, which is fairly significant, and it may still break out yet. So I would watch that one very carefully. There may be a little trade in this stock. So keep an eye on it. $250 is the break point. Even today, which was a half-decent day, not much has happened to NVIDIA, and it's struggling right there. Apple, well, I guess that Apple is just going to move up to its HB2. If I take a look, and I'm going to show you now what the entire history of Apple looks like that we have. There we are. Okay, and look at that. There was the last time that Apple got this high. That was in January of 2008. Prior to that, Apple had never got this high. So, could it reach its HB2? Very clearly. Looking at this chart, it could, because it has done so in the past. Will it this time? Well, it's very close, as we saw. So it could well get there. If it does, however, remember that the market has a memory. And I doubt that the stock will be able to crash through there, in particular because, of course, when we look at the fair market value here, which is already minus 32% lower than the current price, it's going to be quite a struggle if it gets that high to go any higher. Microsoft, well, we've looked at Microsoft before, and we've seen, taking a long view, here's the 2-year view of the company, that the HB1 was it for the stock, and yet now the stock has also, looking at that breakout for the general market over its fair market value, it's pulling Microsoft higher and higher with it. Whether it can actually get to 195, I think that would be pretty heroic. But I think the stock, for the time being at any rate, is in an uptrend. If you buy it, okay, then keep in mind that your stop loss, if you like, if it turns out that that's the wrong thing to do, is $152.66. Anything below there is likely to be a signal that you'd better head for the hills. Finally, I've decided this week that we should probably take another look at Boeing, because the news is not good, and Boeing is very clearly rolling over. Its fair market potential right now is minus 29%. So that would carry the stock back. The fair market value would be $233, so that's below the HB7, which is about 300. However, the real question is, look at the earnings projection for the company. It's $20.61. Well, that may turn out to be pretty heroic. The company is coming under a lot of fire, as we are finding out that here's a company that has sacrificed quality for quantity, and the emphasis has been all on the bottom line and not on kind of the engineering quality of the product, which in the past Boeing has become famous for. In addition to that, all of those nasty emails from employees may well turn out to kind of feed the furnace of the legal woes that the company may well find itself in. So I would be very careful here about even looking at, say, 296, which would be the next immediate breakpoint down, or even 233, which is a fair market value, because that may well disappear if those earnings begin to turn down. The stock, you'll notice the fair market value very recently has turned up because people thought, all the problems are now behind it. And hey, we're going back into full production of the MAX 8. Well, that may well turn out to be a little bit of analyst over-enthusiasm. Be very careful about this company. Finally, the bottom line is, look at the stability ratio of the company. Now, I haven't talked much about stability ratios because the FANGs are in actually quite good shape. But a stability underneath 0.5 bespeaks a very, very weak balance sheet. I have a suspicion that if the stock price collapses, as I think it is likely to do going ahead, that this company may well turn out to be a ward of the state, as it will have to be rescued by the U.S. government from its own potential insolvency. Well, anyway, that was a look at the FANGs for the week. If you want to learn more about our proprietary charting system, then you can visit us at www.strategicanalysis.ca, or give me a call at 416-489-3603. My extension is 133. If you live in the Toronto area, our offices are at 130 Bloor Street West. And I'd be more than happy if you dropped in and we had a chat about our tools, which I think would make you a much more confident investor. Next week, we're going to be giving you a taste of what our clients actually get. These are our breakpoint trades, and over the past year, those trades, and they are trades, have gone up over 90% of the time with an average return of about 20% per trade. Anyway, this has been Ross Healy, the chairman of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you next week.